$9.6 billion just disappeared from the Bitcoin options market in a single moment. Not stolen, not hacked, expired. And buried inside that number is a detail that almost every headline missed. While most people were scrolling past the news, professional traders were quietly closing out one of the most lopsided bets we have seen all year. This wasn't retail money chasing a green candle. This wasn't another ETF headline. This wasn't Michael Saylor adding to Strategy's balance sheet again. And right now, that commitment is leaning further in one direction than almost anyone expected. Before we go further, quick disclaimer, everything in this video is for educational and informational purposes only. Nothing here is financial advice, and you should always do your own research or speak with a licensed advisor before making any investment decision. Markets carry real risk, and crypto carries more than most. Now, before we dive in, if you're new here, welcome to the Wealth Continuum. This is where we break down what's actually happening in markets without the noise and without the hype. If that sounds like your kind of channel, you know what to do. Now, let's get into it. Quick question before we go any further. What are you doing while watching this video right now? Are you on your morning commute, lying in bed, scrolling, or actually sitting down, watching the charts live? Drop it in the comments. I'm curious where this community is tuning in from today. Here's what actually happened. On the 31st of July, roughly 149,000 Bitcoin options contracts expired in a single settlement carrying a notional value of $9.6 billion. That is not a typo. That is close to $10 billion in bets, all reaching their finish line on the same day. Now, why should you care about options instead of just watching the price chart? Because a price chart only tells you what already happened. It's the past, dressed up to look like the present. Options tell you something completely different. They tell you what large, sophisticated traders are willing to financially commit to, ahead of time, about the future. Spot trading is someone buying Bitcoin because they believe in it. Options trading is someone putting real money behind a specific price, a specific date, and a specific direction. That's a much bigger statement. Institutions gravitate toward options because they can hedge, they can leverage, and they can express incredibly precise views on timing, something you simply cannot do by just holding coins in a wallet. So when $9.6 billion worth of positioning clears out at once, it is worth paying attention to. Think about it this way. A chart shows you a trail of footprints. Options show you the actual decision being made in real time, with real money on the line. Here's a question for you. Do you personally think Bitcoin makes a new run at its all-time high before this year is finished? Type yes or no in the comments below. I want to see where this audience actually stands, because I have a feeling the answer might surprise even you by the end of this video. And here's something else worth sitting with for a moment. Most people watching a Bitcoin video today are reacting to the price on their screen. Up a little, they feel good. Down a little, they feel nervous. But the traders behind this $9.6 billion expiry weren't reacting to a number on a screen. They were pricing in weeks of uncertainty ahead of time and putting actual capital behind a specific outcome. That is a completely different mindset than scrolling through a price app and feeling a reaction to red or green candles. This is exactly why options flow tends to lead the conversation instead of following it. By the time a move shows up clearly on a normal price chart, the positioning that set it in motion has often already been sitting there for days or even weeks. If you only ever watch price, you're always a step behind the people who are actually setting the tone in the background. Now here's where it gets genuinely interesting. Stay with me because this next part is the entire foundation of the story. Inside that $9.6 billion expiry was something called a put-to-call ratio, and it landed at 0.28. If you're not familiar with derivatives, don't worry, this is simpler than it sounds. A put is essentially insurance, a bet that price falls. A call is essentially a lottery ticket on the upside, a bet that price rises. The put-to-call ratio just tells you the balance between the two. A reading of 0.28 means for every 100 call contracts out there, only about 28 puts existed to balance them. That is an extremely lopsided number. In fact, it is one of the lowest readings recorded in recent memory. Picture a room of 100 people. 90 of them believe the sun is about to come out, and only about 28 of them are carrying an umbrella just in case. That's basically the mood inside this expiry. Overwhelming confidence, minimal hedging. But here's the part almost nobody talks about, and this is where I need you to really lock in. Bullish positioning does not automatically mean an immediate rally. It means traders are betting on direction. It does not guarantee timing. Markets have humbled far more confident traders than this before, and we're going to get into exactly how that can happen later in this video. Quick gut check for you, and I want an honest answer. Have you personally ever bought Bitcoin or any crypto based purely on a chart pattern without understanding what the options market was actually signaling underneath it? Let me know down below. No judgment, we've all been there. For a bit of comparison, look at what happened over on the Ethereum side of this same expiry. Around 435,000 Ether contracts matured at the same time, but with a put-to-call ratio of 0.63 and a max pain level sitting near $1,850. That's a far more balanced picture than Bitcoin's. Traders in Ether are still leaning bullish overall, but they're clearly holding on to more insurance along the way. It tells you something important. This isn't blind market-wide euphoria. It's a specific, concentrated conviction in Bitcoin that isn't showing up nearly as strongly anywhere else in the crypto market right now. That contrast matters. When an entire asset class gets uniformly bullish, it can sometimes be a sign of blind hype. But when one asset stands out this dramatically from its closest peer, it tends to reflect something more deliberate. A specific thesis that professional desks are backing with real conviction, rather than a general wave of optimism sweeping through the whole market at once. So the obvious question is, why now? Why did professional traders load up this heavily on the call side? A few threads are worth pulling on here. First, institutional demand hasn't gone away, even with a rough month behind us. Corporate treasuries, spot ETF flows, and long-term accumulation strategies are still active in the background, even during weeks where the headlines look ugly. Second, there's a growing belief among professional desks that downside from current levels is limited, simply because so much forced selling has already worked its way through the market over the past several weeks. When the weak hands have already sold, there's simply less selling pressure left to push price lower. Third, macro conditions are shifting in a way that historically has favored risk assets like Bitcoin. Expectations around Federal Reserve policy, global liquidity conditions, and a dollar that has been anything but a one-way trade this year. None of these threads guarantee anything on their own, but stack them together and you start to see why traders were willing to load up this aggressively on the call side, even after a month where Bitcoin gave back a meaningful chunk of its gains. But here's what they're not telling you in most of the mainstream coverage of this story. Positioning like this can just as easily set up a trap as it can set up a rally. And that brings us to the part of this video where things get genuinely important. Stay with me. Worth mentioning too, this optimism is showing up despite Bitcoin actually trading below the $63,000 mark right around the time this expiry settled its lowest level in roughly 10 weeks. That's not a small detail. Traders weren't loading up on calls after a euphoric rally to new highs. They were doing it during a period of real weakness and hesitation in the market. That timing alone tells you these desks believe the recent pullback is closer to exhaustion than to the start of something worse. That's actually one of the more interesting patterns professional traders watch for: conviction that shows up during weakness, rather than conviction that only shows up after price has already run higher. The second kind is easy. Anyone can feel bullish after a rally. The first kind takes actual analysis, and it's a lot harder to fake. This is the part almost nobody explains properly, so let's slow down here. When traders buy a large volume of call options, the firms on the other side of those trades, the market makers, usually don't want to carry that directional risk themselves, so they hedge. As Bitcoin's price moves higher, market makers who sold those calls often need to buy actual Bitcoin to stay balanced. That buying activity can, in itself, nudge price a little higher, which can trigger a little more hedging, which can nudge price a little higher again. This is sometimes called a gamma effect. And in plain English, it just means dealer hedging can occasionally add fuel to a move that's already happening in either direction. Here's the part that should make you sit up a little. This same mechanic that can help fuel a rally can just as easily accelerate a drop if sentiment flips and price starts falling instead. The hedging flows don't care about the narrative, they just follow the math. So if this positioning turns out to be wrong, the very same mechanism that could push Bitcoin higher can just as easily amplify a fall. That's the double-edged sword sitting underneath every large options expiry. And it's exactly why professional traders watch these events so closely, even when the headlines move on the next day. Here's where it gets really concerning, so stick with me for this next section. Big expiries often create a strange window right after they clear, a period where liquidity can thin out unexpectedly, where dealers are repositioning their books, and where price can swing harder than usual in either direction. Sometimes the real move doesn't happen before an expiry, it happens after. Once all that pinned positioning clears the board, price is suddenly free to actually move without the gravitational pull of dealers defending a specific strike level. This is also when you tend to see squeezes, sudden, sharp moves that force traders on the wrong side of the market to close positions quickly, adding even more velocity to whatever direction price is already heading. Long squeezes, short squeezes, it can go either way, and it often happens faster than most retail traders can react to. So here's a real question for you to sit with. If Bitcoin made a sharp, unexpected move in either direction over the next few days, would you actually be prepared for it? Or would you be caught off guard like most of the market usually is? Be honest with yourself on this one. This is also why you'll often hear traders talk about max pain around expiry events. It's essentially the price level where the largest number of contracts expire worthless, causing the greatest financial pain to option buyers as a group. In this particular case, that level was sitting close to $64,000 for Bitcoin. It doesn't guarantee price lands there, and plenty of traders will tell you it's more of a curiosity than a rule, but it's one more data point in a market that runs on probabilities, not promises. Stay with me a little longer, because understanding this next part is what separates people who just watch price move from people who actually understand why it moved in the first place. This isn't the first time we've seen this setup. Wall Street has genuinely seen this movie before. Going back across recent years, there have been multiple instances where a large options expiry, combined with an unusually low put-to-call ratio and heavy institutional positioning, ended up preceding a significant move in Bitcoin's price. Not every single time. Markets don't work in guarantees, but often enough that seasoned traders don't ignore the pattern when it shows up again. The important nuance here, and I really want you to sit with this one, is that history rhymes. It doesn't repeat exactly. The setup looks familiar. The outcome is never promised. And this time, there's a variable that wasn't nearly as present in some of those earlier setups. A much more active corporate treasury buying trend, alongside deeper institutional ETF participation than existed just a couple of years ago. That changes the size of the players sitting at the table, which could make whatever move comes next larger than what we've seen in past cycles. Comment below if you remember any of the previous big expiry events and what happened afterward. I'd genuinely like to know how many of you were actually watching the market back then. We saw a version of this same pattern play out around the end of last year when roughly $27 billion in combined Bitcoin and Ether options expired together, with a put-to-call ratio near 0.38 and a max pain level close to $96,000. That expiry hit at a moment when the market was flush with confidence, and it became one of the more talked about setups of that entire quarter. What followed wasn't a straight line in either direction. It was volatile, it was choppy, and it took real patience to sit through, which is exactly the point. Even when the setup looks convincing on paper, the path rarely feels comfortable while you're living through it. That's the piece a lot of channels leave out when they cover stories like this. They show you the setup and skip straight to the outcome as if the middle part didn't matter. But the middle part is where most traders actually lose money. Not because they were wrong about the direction, but because they couldn't handle the volatility long enough to be right. Let's zoom out for a second, because Bitcoin doesn't move in a vacuum. Federal Reserve policy expectations, bond market behavior, Treasury issuance, and overall dollar strength all feed into how much liquidity is sloshing around global markets at any given time. And Bitcoin, whether purists like it or not, has increasingly started trading like a barometer for that liquidity, alongside its more traditional identity as a store of value. When global liquidity conditions loosen, risk assets across the board tend to catch a bid, and Bitcoin has historically been one of the more sensitive assets to that shift. When liquidity tightens instead, the opposite tends to happen, often faster and harder than in traditional markets. So when you're watching this options positioning, you're not just watching a crypto story in isolation. You're watching a reflection of what large capital allocators believe about global monetary conditions over the coming months. How's the weather on your side today, by the way? I always like knowing where in the world this community is watching from. Drop your city or country in the comments. It's genuinely one of my favorite parts of reading through this section afterward. There's another layer worth mentioning here too. Institutions haven't stopped accumulating in the background, even during weeks that felt shaky on the surface. Large corporate holders have continued adding to their positions, and stablecoin issuers have quietly grown their own reserves, including meaningful additions to their Bitcoin and gold holdings over the past quarter. None of that shows up in a daily price chart, but it shapes the underlying demand picture that eventually does show up in price, sometimes weeks or months later. This is genuinely one of the more overlooked parts of how Bitcoin actually trades in 2026. It's no longer just retail sentiment on social media driving things. It's a layered mix of treasury companies, exchange-traded fund flows, options positioning, and global liquidity conditions, all interacting with each other at the same time. Most headlines only ever show you one slice of that picture. Now, let's be balanced, because a one-sided story isn't useful to anyone, and definitely not to your money. There are real reasons this bullish thesis could fail to play out. An unexpected inflation print could shift Federal Reserve expectations overnight. A sudden dollar rally could pull liquidity away from risk assets like Bitcoin. ETF outflows, if they were to accelerate rather than stabilize, could add real selling pressure. Regulatory surprises, geopolitical shocks, or simple profit-taking after a heavily one-sided positioning setup could all derail this narrative just as easily as they could confirm it. Markets rarely move in a straight line, and anyone promising you certainty in either direction is usually trying to sell you something, not inform you. You need to understand this before I show you what comes next, because the ending of this story genuinely depends on which of these forces wins out over the coming days. It's also worth remembering that options traders can be wrong. They've been wrong before, plenty of times, across every asset class that has ever existed. A low put-to-call ratio tells you what positioning looks like right now. It doesn't tell you what news will break tomorrow, what a central banker will say at the next press conference, or how the market will emotionally react to something nobody saw coming. Confidence and correctness are not the same thing, and the traders behind this $9.6 billion number would be the first to admit that. This is exactly why risk management matters more than conviction. The traders on the right side of this positioning aren't just betting blindly. They're sized appropriately, hedged where it makes sense, and prepared for the scenario where they're wrong. That's a very different approach from someone watching this video and deciding to go all in based on one number they just learned about for the first time. Let's bring this all together. This isn't just a $9.6 billion options expiry that happened and then disappeared from the headlines. It's a real-time snapshot of what some of the most sophisticated money in the world currently believes is coming next for Bitcoin. But that belief hasn't been proven right yet. It's a bet, not a certainty. And markets have one habit that never seems to change. They tend to become the most dangerous exact moment when everyone starts to agree on the outcome. Over the next several trading sessions, this positioning either gets validated or it gets unwound completely. And whichever one happens first is likely to set the tone for how the rest of this year plays out for Bitcoin. So here's the real question I want you to sit with before you close this video. Do you think the institutions holding this bullish position are about to be proven right? Or do you think the market has simply become too one-sided, too confident, too fast? Comment yes if you think institutions are correct, and comment no if you think this setup is a trap. I want to see how this community is actually reading the market right now, not just where price closed today. If this actually helped you understand what's happening underneath the headlines instead of just repeating them. Subscribe if you want breakdowns like this delivered the moment the data actually matters, not 3 days late after everyone else has already covered it. And if you know someone who only follows the price and never looks underneath it, share this with them. This is exactly the kind of thing they need to see before their next trade, not after. This is the Wealth Continuum. We'll see you in the next one.